how to use call options to generate passive income. We're going to be going over the most basic call options strategy known as covered calls. I'm going to be speaking to you as if you know nothing about call options or covered calls. So let's begin. This is going to be unedited, unscripted, so please bear with me. And we're going to be doing this as if you were buying the call options from me. So this is a transaction with me and you. So let's begin. Let's say I buy JP Morgan stock, so JPM. I bought JPM, and how do I want to make money off JPM? Well, first, I want the price of the stock to go up. So I want to make money through price appreciation. Secondly, if this company pays a dividend, which it does, then I want to make money with dividend income, which it will. And thirdly, I want to make money with covered calls, and I'm going to show you how. Let's say the current price of JPM, so let's say current price, let's say the current price is $100. And let's just say, oh, right, let's write it here, 105. Let's say I will sell you the option to buy my stock from me at the price of $105 within the next 30 days. So that's the expiration date. And in order for you to have that option to do so, I'm going to charge you $2. So you're going to pay $2 for that option. So don't get overwhelmed. We're going to break this down piece by piece. Again, to summarize, the current price of JP Morgan stock is $100. I'm giving you the option to buy this stock from me for $105 within the next 30 days. And for you to have that option, it's going to cost you $2. From your perspective, as you, the person buying that call option from me, what do you want the price of JP Morgan to do? You want it to skyrocket, and I'll show you why. Let's say it goes up to $120. If the stock of JP Morgan goes up to $120, then you have the option to buy my stock, JP Morgan stock, from me at the price of $105. If that's the case, then you would buy my stock from me at $105, and then you would just instantly sell it at $120. In that case, you make a gain of $15 minus the $2 you paid me for that option. So you would be up $13. Now let me get rid of this so we don't get confused. So that's from your perspective. Let's say from my perspective, the person writing the call option, doing the covered call. Remember, I bought this stock for $100. And let's go over the scenarios of what happens in each scenario, because there's many ways that you can win, that I can win in this situation. Let's say the stock price of JP Morgan falls to $90. I bought it for $100, it fell to $90, let's say on the 29th day or the 30th day. So basically, the option, the time frame is expiring. The stock price fell to 90. If this is the case, would you want to exercise the option? Would you want to use that option to buy this stock from me at $105? Absolutely not, because you can just go onto the stock market and you can buy JP Morgan stock for $90. So why would you want to buy JP Morgan stock from me at $105 when you can buy it for $90? This is a situation where the option that you have is expiring worthless. It's out of the money. It's not in the money. From my perspective, this is great because I just made $2 from the option I sold you, which is expiring worthless. Unfortunately, the stock fell $10 in value, but at least I made $2, so I'm down a net $8. That's the situation where the stock price falls. Let's say the stock price does nothing. It's the same thing. After 30 days, let's say the stock price is the same. It's $100. In that case, why would you want to exercise the option and pay $105 to buy from me JP Morgan stock when you can just go onto the stock market and buy for $100? So no one in their right mind would exercise this option and buy it from me for 105 when it's worth 100. In that case, it's the same thing. I'm gonna pocket the $2 for the option I sold you and expired worthless. In this case, through price appreciation, I didn't make money, I didn't lose money, but I pocketed $2. So I made money on the options premium. Okay, let's say the third example. Let's say the price, I bought it for $100, and after 30 days, the price is $104. In this case, again, why would you want to buy my stock from me for $105 when you can buy it on the open market for $104? In this example, your option is going to expire worthless because you can buy it cheaper on the open market rather than exercising your option and buying it from me for 105. So in this case, what happened? From my perspective, this is great because I made $4 by the stock going up, and I also made $2 from the options contract that I sold you that expired worthless. So let me get rid of this. Okay, so here's the downside from my perspective. Let's say the stock does go up to $120. This is the worst case scenario for me, because what happens here is that I bought it for $100, but the stock price shot up to $120. If I did not write this call option, then I would have been up $20, and that would have been awesome. However, now I am limiting myself. I'm limiting my gains to 105 plus the options contract. In this case, the stock price went up to 120, but I am forced to allow you to buy it from me, so I need to sell it at 105. In other words, I need to sell it for 105, so I make $5 from the price appreciation, and I make $2 from the contract price that I sold it to you for. So in this case, I made $7 when I really could have made 20. So by doing this covered call strategy, you're limiting your upside potential. However, the question is, would you be upset if this scenario panned out? Because you made $5 on the price appreciation and you got money off the options contract. So I mean, yeah, I guess you could have, optimally speaking, you could have made $20, but I don't know if that would allow you to complain because you made money both ways. So that is how options contracts work with call options and covered calls. I hope this helps. If you have not done so already, please check out our other investing videos. We have a great video library, investing for beginners, people who are new to the stock market, and also intermediate level stock videos as well. And you can also follow our stock accounts, what we are doing with our $100 portfolio, our $500 portfolio, and our $100,000 portfolio. If you haven't done so already, please subscribe, and I will see you in the next video. Thanks so much, and take care.